Welcome to Market Overtime. I'm Diane King Hall at the New York Stock Exchange. How do you prepare for the trading week? The answer for many investors is with the Kobeissi Letter, a weekly newsletter that offers commentary on stocks, energy futures, gold, bonds, and the options market. To discuss where the market may be headed in 2025, I'm pleased to welcome in Adam Kobeissi, founder and editor-in-chief of the Kobeissi Letter. Adam, thank you so much for joining us
Thanks
today.
for having me.
All right, Adam, let's start with this. So for those who aren't familiar with you, tell us a little bit about your background and what led to creating the Kobeissi Letter.
Absolutely. So we're going on 10 years now of the Kobeissi Letter, and I started it honestly just as a hobby. I was always an investor, always followed the markets, but I thought it was cool to just kind of put online what I thought was going to happen from a more macroeconomic perspective. You know, what really differentiated us over time was I back in 2015, if you were talking about technical analysis, it was like you were doing something illegal. Like it was like no one cared about it. But it was something that I saw early on as a trend that I think was going to increasingly drive markets, particularly because a lot of trading in the market had become automated and algorithmically based. So I would see price react to different support and resistance levels. I started to realize different correlations with different assets and the technical setups that they were presenting. And I thought, why not? Why do you have to pick one or the other? It was always, are you a technical analyst or a fundamental analyst? Why not just be both and combine them? And I kind of use that approach. So the way even to this day, the way my analysis is structured is that the fundamental side of things is the overall investment thesis, the driver, and then the technicals are like your roadmap, like when you're taking a road trip. You know where to put your stop loss, where to put your target, and how to manage your risk and reward. And so far, it's been very successful.
So that's your GPS, basically. And I have noticed that trend, too, to your point, that the use case for technical analysis usage of technical analysis has increased over the years. And seems to be even more important now than it was once upon a time. I don't want to date myself for how long I've been covering markets, but it's been a minute. All right, so talk to us, though, speaking of how long you've had the Kobeissi Letter to now, how has your view or even analysis evolved over that time?
I mean, I think the market has completely changed. Even over the last 5 years, the market, like pre-COVID and post-COVID markets, are completely different. Right now, estimates show over 60% of daily trades are just completely automated. So the majority of majority of trades being placed are through automated means. And also, you have retail investors are involved in the market at record levels. So prior to the pandemic, I remember every day you'd open the news and the latest headline was the death of the retail trader. No one in retail is trading. Volumes are down. Pandemic hit, and I feel like that's also what really allowed us to gain more traction. We bring the institutional side of investing to Main Street. So we bring Wall Street to Main Street. And I think that in itself has really changed the way markets are moving and the way they will continue to move in the future.
Do you find that there's more of an appetite for information and knowledge to be able to access the markets from retail investors now?
Absolutely. And I think right now, more than ever, information is not only readily accessible, but very important because markets are instant now, right? It's not like it was in the past where the news would spread and then things would move. And that's a lot of it because of automation. The minute something happens, it's priced in, and look at Twitter or X. X has been where we gained a pretty big following and what has really allowed a lot of retail investors to get access to market-moving information. So it's incredible to watch what's really happening.
Speaking of trends, one thing that has been talked about recently is kind of the momentum trade. Do you believe there's something to that?
I absolutely do. I think sentiment is the ultimate driver of price, and that is something that a lot of people fail to realize. The market is, in a way, always right. Even when you think the market is wrong, you have to trade the price action you have. And that price action, a lot of the times, is based on expectations, right? Sentiment. If there's euphoria in the market, that's something that we've been ahead of all year. We've been buying all the dips in the S&P 500 this year, and not because we were so bullish about everything and all the different headwinds, more so because momentum was strong, the technicals were strong, and it's a difficult market to fight the trend in. So I think momentum is everything. You see it in a lot of different asset classes. Look at Bitcoin, right? When Bitcoin breaks, it broke 100,000, it goes to 105, just like that. Or vice versa. So.
No, you make a great point, because even though we saw this massive risk-on move in the wake of the presidential election, right? And you saw the Trump thump happen here, or Trump bump, however you want to characterize it, here to equities, and you saw the bullish run the S&P 500. Although recent days it's been a little bit more range bound, but Bitcoin has just continued to shoot higher and higher, even when you see some cooling in other asset classes.
Absolutely.
I find that fascinating to see that, because I don't know that the correlation is exactly lockstep currently.
Bitcoin, it started out as a safe haven, and then it became a risky asset, and it was really actually trading pretty much not in line one-to-one with S&P 500, but in the same direction for much of the last couple of years. Now you're seeing, regardless of what happens in the market, Bitcoin is rising and gold is rising. So Bitcoin and gold now are no longer even necessarily substitutes. They're in a way they can rise together, and it's almost like Bitcoin is the risky safe play instead of just a safe play. And Bitcoin's the ultimate definition of a momentum trade, and it's something that anyone that has tried to fight over the last few years has gotten pretty burned on.
Because on one hand, it's a very volatile trade, because it went through the crypto winter, and many people were caught on the losing end there. But then you had the crypto bulls who were believers, and the Bitcoin bulls, and you saw the widening adoption of Bitcoin in particular this year with the ETF wrappers, and then Ethereum seems to still be playing catch up to Bitcoin, but it seems like the legitimacy around it has increased this year.
Yeah, and I think for the first time in U.S. history, really, you're now seeing policy that's going to be completely pro-crypto. I mean, every headline coming out of the new expected policies from the Trump administration are appearing to be pro-crypto, including replacing the SEC chair himself.
Yeah, it makes sense, which he's been very anti-crypto,
exactly.
it seems.
And I think that is, at this point, with crypto and Bitcoin itself being a $2.1 trillion asset, I mean, now the 7th largest asset in the world, it's almost like it's too big to fail at this point.
Yeah. Let's talk a little bit about your S&P 500 targets. I know you mentioned you've been bullish on the S&P 500. You have a target for the year, and I think about when you think about the predictions when you went to the end of last year, like if you think back to a year ago, and there were generally predictions that we would see another increase in the S&P 500 this year. Many predicted that we'd see a double-digit increase, but not the level that we're seeing as we close out this year. The expectation was that we'd see a smaller percentage run up in the S&P 500 compared to the jump that we saw in 2023. Where do you stand on where you think the S&P 500 will land by the year end?
Well, so we have been bullish all year, buying all the dips. And months ago, we started saying S&P to 6,000. That was our big thing. And at the time, everyone said, "Are you crazy? It's an election year. There's geopolitical tensions. There's every headwind in the name. Fed in the game was there. The Fed was starting to cut rates, but no one knew how much they're going to cut by." And we actually had inflation starting to rise at the beginning of this year, and even now we're starting to see it back on the rise. But we said S&P 6,000, and we actually just raised our target to 6,150.
Yeah, you had to.
We had to. But look, I think one of the first realizations we made, and this is obviously in retrospect now, but we made this realization going into 24, was election years are actually very bullish. Yeah. And I don't know where this narrative came out that in an election year just get out of the market, because if you look at the data back to the 1920s, the S&P 500 actually rises more on average during election years than it does in other years. And regardless if a Democrat or Republican wins, I think it's around 11% gain on average in the year for Democrat wins, 15% of Republican wins. But either way, it's incredibly strong. And even from November 5th to December 31st, you also have an average return of about 3% positive in the positive direction for the S&P. Meanwhile, you had the Fed cutting rates. So you had all these different things. But at the core, it goes right back to that momentum trade, and that bullish sentiment, I think right now is at record highs. I don't think we've ever seen more euphoria. And, does that mean the bull trade is getting crowded into 25? Maybe. But I don't think right now is the time to fight that trade, and that has really been our viewpoint all year.
You talked about, how the market has changed and even how analysis has changed over the past decade and in particular over the past 5 years. What recent trends, though, or events have you found most surprising, especially when you think about their relationship or impact to the markets?
Well, I think number one is the Fed. Take a look at what happened with the Fed over the last 2 years. You've had Fed pivot calls maybe 5, 6 times, maybe more. I think the Fed has pivoted every month at this point, and then gone back. You had inflation rise now twice. Where my latest call is that inflation is going to rebound in 2025, and you've had now 100 basis points of rate cuts in 2024 effectively, but the market does not care. It just goes up regardless, and I think that has been the most surprising thing to most people. And if you were able to get ahead of that trend, it was an incredibly profitable trade. All these, brief dips that we saw.
Are you bullish on the S&P 500 for 2025?
Yeah, I think into 2025 we are bullish. I think I want to see how the inflation data pans out. I want to see how the labor market pans out, because right now we have a situation where I personally think we're seeing modest stagflation, where the labor market is starting to weaken, and by economic definition, we are still at maximum employment, under 5%, but it's definitely weakening. And for anyone that is not paying attention, the headline numbers are worthless. You have to look way deeper into the jobs report. You have to look into the revisions. You have to look into wage growth. You have to look into part-time employment. All of those things are pointing to two things: weaker labor market, higher inflation into 2025. And I think markets and the Fed are going to both have to eventually take a pause and say, we can't cut rates as aggressively as the Fed was hoping for. And that means that inflation is going to run higher than their 2% target for longer than initially expected.
That last mile has been really hard to reach for the 2% target on inflation. And then now you add to that the concern that we'll see an uptick in inflation with the tariffs. I mean, that has been a pledge that President-elect Donald Trump has, reiterated time and time again, that we will see tariffs. It's just a matter of when and maybe to what level. How much do you think that will impact inflation?
It really depends on, and by the way, it is inflationary in that even President Trump himself has said that Americans may have to pay higher prices for certain goods, because that's what tariffs are. It's passed on to the consumer ultimately, these higher costs. The question is, how severe will these tariffs be? Because there are already existing tariffs from even when Trump was first in office, there are still tariffs. There are tariffs from Biden, specifically on China. But then we've seen a lot of different threats for tariffs Trump wants to impose, but nothing solidified yet. I think, the Canada-Mexico thing that came out most recently, that would be pretty big. Trump even said he would put 100% tariffs on countries in BRICS that are threatening to replace the U.S. dollar. That would probably be the largest tariff in history, because there's about 34 potential countries that will be in BRICS at this point. And if there's a 100% tariff on every single one of those countries, it would, most goods would probably double in price. So a lot of those things I don't think are going to actually come to fruition. I think they're more just, calling attention to the topic and saying we need to get something that works better here. But right now, I think we'll see some impact on inflation, but it won't be anything too huge to worry about for now.
When it comes to the relationship between the U.S. and China, do you expect another kind of tit-for-tat tariff trade situation?
I'm hoping something can be, at least avoided, or some sort of middle ground can be reached, because that is really what happens. It's like one side starts, the next side retaliates, and then it just keeps on going. I think it does, in a way, help, quote unquote, that there are some existing tariffs that are already there. That if you just keep building tariffs on tariffs, at some point it's going to freeze the economy. I'm looking at EVs. EVs are going to be a very interesting topic. I know, obviously, Elon Musk has been very pro-Trump. People are expecting more, federal subsidies towards EVs, or just general federal appreciation and help towards the EV industry. But China's become a major player in the EV space.
They have. And BYD, et cetera.
Absolutely, and they're effectively, in a way, leading EV production at this point globally. So that will be something that we're watching, especially as Tesla now is becoming, one of the largest companies in the world, seemingly overnight. So.
Yeah, are you bullish on Tesla given the, relationship with President-elect Trump? his role in the new Trump administration. I know it's not an actual unit, the DOGE, Department of Government Efficiency.
Right.
But does that make you bullish? Does anything about that, or do you pay more attention to kind of the fundamentals? And we had even seen some recovery in the fundamentals.
I mean, Tesla is obviously a microeconomic thing,
yeah, exactly.
right? But,
yes.
Am I bullish on Tesla? I think what you're seeing right now is everyone's saying I can't be bearish on Tesla.
Okay.
It's a very dangerous stock to be short of right now, which is the exact opposite of what we saw over the last couple of years, because you never know what's coming. It's like almost like the market is trying to price in this plethora of potential catalysts to the upside. And I think right now you're seeing the ultimate, one of the biggest short squeezes probably in history take place in Tesla. I don't think it's something that you fight.
And then, so let's widen out and talk sectors that you are bullish or bearish on for 2025. Let's start with the bull case. What sectors are you bullish on for 2025?
Well, look, I think if you're bullish of the market, you have to remain bullish of tech, because tech is effectively the market at this point. I do think a lot of these semiconductor stocks, even NVIDIA, which was obviously one of the hottest stocks of 24 and 23, recently has been pretty stagnant, actually trending lower. AMD is down now over 10% year to date. So I think some of these names are finally seeing consolidation and some technical pullbacks, and I think that's what you need. You can't just have a straight line higher in a healthy market. And while that happens, you're seeing the rally broaden out a little bit, which is also constructive for our view. So I do think tech does well. I'm watching consumer discretionary stocks. I think that's the number one thing to watch here, as consumers are increasingly taking on record levels of debt. Inflation's returning, prices are rising. I read a stat that around 30% of current holiday spending from last year is still being paid off.
Yeah.
So.
Yeah, I saw that. I know, it's so fun. It's been interesting to watch the consumer over the past couple years, because there were so many concerns last year about the consumer being just overextended and stretched last year. And then we had different conversations throughout this year about the wind down of the savings, the pandemic era savings. But it doesn't seem that the consumer is tapped out, or if they're not tapped out when it comes to savings, you know, they are a little stretched when it comes to credit. And of course, there's been the rise of BNPL, which we don't have as much visibility on as we do with credit card levels. But let's talk about sectors that you are bearish on for 2025. What do you expect where do you expect to see weakness?
Yeah, I mean, I think number one, I said consumer discretionary is one. I think the whole consumer sector as a whole, retail, I'm watching to see how that pans out, specifically with holiday spending. Buy now, pay later, the BNPL that you mentioned, is honestly probably the biggest driver of holiday sales at this point, with around $19 billion of holiday spending on BNPL expected. That's according to Adobe. How long can that fuel last, and how long can credit keep building? I think you hinted to that. It's tough to say it's going to be much longer, especially with rates being higher for longer, and credit card. People are paying 25% on this credit card debt. More.
I've seen levels around 35%, which how could one sign up for that?
It's insane. It's like at some point it's like, how do you even get ahead of that payment if you're not making significant amounts of money to pay down that debt? You're just going to be paying interest forever. So I'm watching that. You know, one sector I actually am looking at is utilities, which have utilities and also energy. I think those are going to be two interesting spots, because as people see more uncertainty coming to the market, they do tend to rotate into utilities. But also, it's a situation where maybe we have a soft landing, maybe we don't, maybe we have rate cuts, maybe we don't. So I think that'll be an interesting spot, as well as energy. I think with these oil giants have been kind of bogged down recently with the recent drop in oil prices. Now oil prices rising back above 70, talking about inflation again, OPEC pushing back production cuts. That's going to be an interesting spot to watch.
So you mentioned oil prices. They're a little lower as we talk today, but they've been in this range recently between kind of 65 to 70. Are you bullish on oil? And if so, why? Yeah,
we've been moderately bullish. I think when prices fell towards that bottom end of the range, we've been trading this range. It's been a great range to trade. We took some longs, called for a move back towards 75. Do I think we see 100 plus? No.
Sorry. I mean, it doesn't seem that way now.
No. And do I think we see sub 50? No. I think what you have now is a situation where on the bottom end of the range, you have OPEC pretty adamant that they don't want prices below that $60 to $65 range. And you also have just general economic optimism. But then when you get to the high end of the range, you start seeing the weaker import data from China. You start seeing weaker just general demand forecasts into 2025. OPEC even revised down their demand projections for 24 and 25. So it's kind of been oscillating in that range, and I think it's going to continue to trade in that range for now. But if things can improve in 2025, or if they get worse, I think that range breaks to either direction, respectively.
I want to hear another 2025 view from you, because we keep kind of veering in and out of the conversation. It's a natural thread. It's the Fed, right? And at the beginning of this year, there were all these calls for 6 rate cuts this year. We didn't see that, obviously, this year. And, you started to have some expectations ratchet down throughout the year. When you think about 2025, what's the setup that you're anticipating when it comes to the Fed?
Right. So what's happening is the exact opposite of what happened going into 2024. 2024, the Fed. And I really think this is where all the problems started. In December of 23, the Fed basically declared victory against inflation. And it was the strangest thing. No one can even answer to this day what happened. But 2 weeks prior to the Fed meeting, Powell went on, I think it was CNBC, and said, it's premature to talk about rate cuts. And then 2 weeks later, it was, we see 3 rate cuts coming. And then markets actually started pricing in 8 to 9 rate cuts at one point.
I do remember it was higher than 6 at one point.
And then now we've come all the way back down, and then going into 25, it's now the exact opposite situation where people are saying rates are going to remain higher for longer, inflation's back on the rise. I still think we reach a middle ground, maybe 3 to 4 more cuts of 25 basis points in 2025. But if we do end up in a situation where inflation just starts skyrocketing again, that's obviously something that's going to be concerning and may warrant even rate hikes. But you also had the other end of the spectrum where the Fed can't have unemployment rising above 5% right now. They just can't with the current backdrop. So I'm watching to see what is the Fed going to prioritize, inflation or employment. And it's their dual mandate, so they have to technically do both. But they always, prior to September, it was all about inflation. Then it switched to the labor market. Will they switch back? I don't know.
Speaking of the labor market, you talked about some cracks under the hood when it comes to the labor market. And one of the things I have noticed is the, part-time, people working part-time for economic reasons. That's one of the metrics that stood out to me. Tell me again the metrics that stand out to you and why those matter to you in terms of the concerning pieces of the labor market.
Let's start with part-time. You have more people than ever working multiple jobs right now in the U.S. And
is that a bad thing?
Well, so that's the first question. Is it a bad thing? The question is, why are they working multiple jobs? Well, the answer to that is a lot of these people need multiple jobs just to afford basic necessities. And then you also have initial jobless claims and full-time jobs rising. And you see just different pockets of weakness like that within the economy. A lot of the jobs, for example, look at where let's take the headline number in the jobs report. Where is most of the growth coming from? Government jobs. And that's something that's also concerning. And then look at revisions. Revisions have been probably the most puzzling and concerning part of all the data this year. 8 of the last 12 jobs reports revised lower. Some revised lower twice. You had that massive revision in August of nearly 1 million jobs lower. So I think what's happening is you're seeing the headline number. It seems strong. The next month goes by and it's revised lower, but no one remembers the previous month because the next month had another beat, and then that cycle repeats. It's definitely a weaker labor market than it appears on the surface level. Okay,
and then let's talk a little bit about volatility. It hasn't been very volatile recently, but what are you preparing for, bracing for in terms of market volatility?
Yeah, the cost of insurance in the market right now is historically cheap. I mean, it's just objectively, it's very cheap. And every time that it gets this cheap, it always rises. That's just how it works. And I think we're going to see more volatility in 25. That's actually been our call. And if you're an investor, if you're a trader, you should warrant volatility, because without volatility, it's boring. You want swings in the market because you can trade those swings, right? So I'm excited for it. I think we see larger swings in both directions. Could that mean we ultimately trend higher? Absolutely. But I think that the days of just seeing modest 50-point pullbacks in the S&P or different asset classes are numbered, especially as more uncertainty comes into 25.
You briefly touched on gold earlier, and I don't want to lose that point. Gold has hit record after record this year as well. We talk about stock market, and we've seen records there. Where do you see that pattern continuing in 2025?
Yeah,
and why?
yeah. I think we'll see 3,000 in gold, and I think the reason for that being, number one, look at the U.S. dollar to gold. If you put a chart of them together, it's interesting. Recently, they've been rising together, and that never really happens in history.
Right.
This relative strength of gold, even if gold went down 1%, while over the last 3, 4, 5 weeks with the U.S. dollar's appreciation, that's incredibly bullish. I mean, if you look at any other time in history and you told me the U.S. dollar would rise 6 to 7% in a couple months, gold would have been down at least
Exactly.
10%.
It doesn't normally.
Right.
A stronger dollar is not usually bullish for gold.
Then on the other hand, look at central bank purchases. We're seeing record purchases in central banks year after year. China's central bank alone is stocking up. India, Turkey, all over the world, they're stocking up on gold. And meanwhile, they're calling for a soft landing. So it just doesn't add up. When you have higher inflation expectations, when you have more uncertainty, you have geopolitical tensions, I think it's a perfect recipe for higher gold prices. And I think people are not super eager to get into things that have currency risk, like just getting into the U.S. dollar, for example. Park your money in other assets that are inflation protected.
And let's talk a little bit again about the tech leadership that you mentioned earlier. You talked about NVIDIA, AMD. I know AMD is not a part of the Mag 7, and there could be a case that AMD just hasn't lived up to the expectations when you think about the setup for this year, because AMD was supposed to be the number 2 after NVIDIA, and that just hasn't materialized that way. Not to say that there hasn't been any demand for their chips, but it's just been a slower adoption when you think about this space. And I always liken NVIDIA to kind of the Usain Bolt of that sector. But in general, this year it's been about the tech leadership. There's been some broadening out through this year, but it's kind of gone back to, if it ain't broke, don't fix it in terms of the tech leadership. Do you expect tech to still be the leader in 2025?
I think it has to be the leader because it's just become so large. The top 10 stocks in the S&P 500 are now bigger than like 5 or 6 global markets combined, like Japan and all these different countries, Germany. So if it's not the leader, then you're going to need to see a big broadening out of the rally. But AMD, we talked about AMD versus NVIDIA versus different chip names. I think what really happened this year is NVIDIA solidified itself as just a mammoth leader of the space, and everything else is just competing for basically 10% of the AI
What's
chip
left,
market.
yeah.
Right, it's like you're fighting for little slivers. And I think going into the year, people were saying maybe it will be NVIDIA and AMD. Does that mean AMD is dead? No, they're still selling tons of chips. They're still doing very well. And could that mean that another buying opportunity is coming? Absolutely. But I think it's not necessarily that AMD is doing poorly. It's more that just NVIDIA has been doing so well.
Okay, and I want to ask you a quick reflective thing, and then I want to kick it forward and get a crystal ball kind of point of view. What has been, if you think back on the calls you've made in the Kobeissi letter, what's been your biggest, like your most bullish call and your most bearish call? Were you right on those? Do you remember?
Yeah.
And then we'll kick it. Well, let's start with that before I kick it forward.
I mean, that's a tough question. My most bullish call was probably, I don't know, maybe buying NVIDIA at $9 a share a few years ago, still holding.
I would too.
That was one of my biggest calls.
Okay.
One of my biggest bear calls, shorting oil prices in 2020 when they went negative. That was an incredible thing to watch. They were paying people to take oil.
All right, and
First time ever.
I want to get your final thought on 2025, your crystal ball view. What bold prediction are you ready to make for 2025?
I mean, one I said was gold to 3,000. I think we see S&P 500 to 7,000.
Okay.
That's my bold prediction.
S&P 500 to 7,000. That's the view.
That's the view. I think people are going to be shocked again. I think it's going to be this momentum rally continues, and people are going to be applauding this deregulation, and then from there on, we might start getting more rocky. But I think we see big swings, but dips still bought.
All right, that's the number to watch. You heard it here first from Adam Kobeissi. All right. Our thanks to Adam Kobeissi, founder and editor-in-chief of the Kobeissi Letter. This has been Market Overtime. We have new episodes each week on schwabnetwork.com. You can find the full archive on the Schwab Network YouTube page. I'm Diane King Hall. Thank you so much for joining me.